Welcome to the Deep Dive. Today, we are taking aim at one of the most foundational pillars of modern economics.
Oh, absolutely. The big one.
The model that dominates pretty much every single introductory macroeconomics textbook on the planet, the ISLM analysis.
Right.
This framework has guided policy. It's guided education for, 80 years now? And today, we're going to use some pretty serious mathematical rigor to expose its fatal flaws.
It is the standard framework, yes. But what our sources really dig into is that this classic model, the one that tries to explain economic crashes and policy solutions, it's built on assumptions about how money works that are just fundamentally flawed.
Okay, so not just a little bit wrong, but fundamentally wrong.
We have some very rigorous mathematical and dynamic analysis, all based on system dynamics modeling. And it basically proves that the ISLM structure cannot accurately explain real-world crises.
Like the big ones.
Exactly, like the Great Depression or, Japan's lost 30 years. It's perhaps the longest running, let's call it a mythology in economic education.
That is a colossal claim. I mean, we are talking about undoing decades of economic education here. Rejecting the graphical tool that everyone, and I mean everyone, uses to visualize fiscal versus monetary policy.
Right.
So our mission today is to go beyond those simple graphs you might remember from college, those shifting curves, and really use the dynamic analysis in the source material to uncover why those models fail.
And we're going to explore this radical shift in how economists must view money creation. I mean, moving from the easy assumption of exogenous money
to the reality of endogenous money, a shift that, if you take it seriously, changes everything.
It really does.
Okay, let's unpack this. Let's start with the basics of what we all learned.
So to set the stage, we have to start with the foundational model itself, the ISLM analysis.
Right.
It was devised by John Hicks way back in 1937. And it was basically his attempt to formalize Keynes' revolutionary general theory, which had just come out a year before.
And it just took over, didn't it? It became the textbook standard for short-run macroeconomics. Why, though? What made it so popular?
Well, because it offered a clear, a quantifiable way to analyze the interaction between the real economy and the financial sector. It was neat.
It put it all on one simple graph.
Exactly. So just to define the acronyms for you, the listener, the model links two major markets. You have IS, which stands for investment and saving.
That's the goods market equilibrium, everything to do with actual stuff being made and bought.
Right. And then you have LM, which is liquidity demand and money supply.
Yeah.
That represents the equilibrium in the money market.
And the whole point of the model, the magic of it, is that the economy is supposed to exist at that single point where the two curves cross.
That one intersection, yes. And that point determines the unique equilibrium interest rate, we call it I star, and the income level, Y star, for the short run.
Okay, so to really understand its limitations, we need to get under the hood and look at the math.
Exactly. Our sources lay out the 9 core equations of this short-run model. Equations 8.1 through 8.9. They describe all the fixed relationships between these variables.
Let's walk through the goods market first, the IS side of things. It all starts with aggregate demand, right? AD.
Right. Total demand for goods and services.
Yeah.
And it's defined simply as the sum of consumption, investment, and government spending. So AD equals C plus I plus G.
Simple enough.
And each of those has its own little equation. Consumption, C, is determined by some baseline autonomous consumption, C0, plus what's called the marginal propensity to consume, little c, which is applied to your disposable income.
So some baseline spending plus a fraction of whatever you have left after taxes.
Pretty much. Then you have investment, I. This is critical because it's the piece that links the goods market to the interest rate.
Right.
Investment is inversely related to the interest rate, I. The idea is simple. If interest rates are high, it's more expensive to borrow for big projects, so investment falls.
And that relationship is governed by a parameter, alpha, which is the interest sensitivity.
Correct. And then finally, you have government expenditure, G, which is just assumed to be exogenous. It's a fixed number set by policy.
Okay, and here is maybe the most important simplification of the whole IS curve. The idea that real income, Y, is just assumed to be equal to aggregate demand, Y equals AD.
Yes, the principle of effective demand. It means that production, or GDP, adjusts instantaneously to meet whatever demand there is.
Which is a huge assumption.
A massive one.
Yeah.
It basically assumes firms can ramp up or shut down production lines immediately in response to demand. In the real world, of course, that's not how it works. And that's a key simplification we'll have to overturn later.
Okay, so that's the IS side. What about the money market, the LM side?
So the LM side is all about the equilibrium between the supply of money and the demand for it. The equilibrium condition is often expressed in relation to the quantity theory of money.
The famous MV equals PT, or in this case, the real money supply times velocity equals the demand for money.
Precisely. And the demand for money, LD, this is Keynes' big contribution here. He called it liquidity preference.
And he broke it down into two parts, right? Which is what gives the LM curve its shape.
Exactly. First, you have transactional demand. That's the money you need for everyday purchases, and it's proportional to your income. More spending, more cash needed.
Makes sense.
Then you have speculative demand. This is the money people hold as a safe asset instead of, say, putting it into bonds. And this part is inversely related to the interest rate.
Because if interest rates are high, the bonds are paying a lot, so you lose more by just holding on to cash. The opportunity cost is high.
You've got it. So the full demand function is LD equals AY minus BY. The A is income sensitivity, B is interest sensitivity. But here is the single most crucial assumption that underpins this entire textbook classic.
The one that everything else rests on.
Yes. The fixed price short-run ISLM model assumes that the price level, P, and the money stock, Ms, are exogenously given.
They're fixed. They're inputs that come from outside the model. The model itself can't change them.
Correct. They are just numbers you plug in, controlled externally.
So if all these equations are fixed, the only way to do policy analysis is through what's called comparative statics.
Right. You just compare the old equilibrium point to the new one after you shift one of the curves.
If the government changes spending or taxes, that's fiscal policy.
You shift the ICE curve.
If the central bank changes the money supply, that's monetary policy.
You shift the LM curve. Simple as that.
And the simple framework is what sets up the central macroeconomic debate that you see in so many textbooks like Mankew's, especially when they try to analyze huge events like the Great Depression.
Exactly. The sources show there are two competing views that this model is supposed to help us test.
Okay, let's hear them.
The first is the spending hypothesis. This is the one primarily associated with Keynes.
Right.
It basically says the depression was caused by deep shocks to the real economy. Underconsumption, a collapse in investment. That means a huge leftward shift of the IS curve.
And second view?
That's the money hypothesis, championed by Milton Friedman and Anna Schwartz. They argued the Fed was the main culprit, that the Fed let the money supply fall off a cliff, which causes a big contractionary leftward shift in the LM curve.
So an IS shock versus an LM shock. And the critical question here, the reason we're doing this deep dive, is whether this simple static ISLM model can actually resolve that fundamental historical dispute.
And our sources say emphatically no, it can't. And this is where it all starts to unravel.
Okay, so now we get to put the textbook model on trial. We get to stress test it against historical reality.
And the reality is the devastating data from the initial collapse of the Great Depression from 1929 to 1933. I mean, this period was just widespread economic destruction.
The data is just brutal, isn't it?
It's unambiguous. Real GNP, consumption, investment, the nominal interest rate, the money supply, the price level, they all fell. Dramatically.
The entire economy just contracting across every single vector.
It was. The nominal interest rate in particular fell continuously. But there was one sort of confounding variable. Real money balances, M over P.
What happened there?
Well, even though the nominal money supply, Ms, was contracting, the price level, P, was collapsing even faster, which meant that real money balances, your actual purchasing power, actually rose slightly from 29 to 31 before it started fluctuating.
Okay, that's a really important detail. So let's take the textbook model. We're calling it Case 1, fixed price, exogenous money, and apply Mankew's analysis of the money hypothesis, the LM shift.
Right. Mankew himself rejects this hypothesis, and we need to understand exactly why, because it points directly to the model's structural failure.
So what are his reasons?
He identifies two major problems for the LM shift explanation. First, that real money balances issue we just mentioned.
Okay.
A contractionary LM shift, by definition, means the curve is moving left, because real money balances, M over P, are falling.
But the data just showed us they slightly rose.
Exactly. If real balances rose, the LM curve would have, if anything, shifted slightly to the right. Or at the very least, it wouldn't have shifted left enough to explain the massive collapse in income. The data and the model's mechanism are going in opposite directions.
Okay, that's problem number one. That's pretty damning. What's the second one?
The second one is even worse for the model. It's the interest rate behavior.
Right.
If a big contractionary LM shift happened, let's say the Fed just yanked money out of the system, the model predicts that the equilibrium point would move up along the fixed IS curve.
Which means the equilibrium interest rate, I star, would have to rise.
You would have to rise significantly. But, as we just saw, the historical data shows that nominal interest rates fell continuously throughout this entire period.
So the model's prediction is the literal opposite of what actually happened in the real world.
Diametrically opposed to the empirical facts. So the simulation of the money hypothesis leads definitively to a rise in the interest rate, which violates the evidence, so Mankiw rejects it. He says it just cannot explain the event.
Okay, that makes sense. But this is where it gets really interesting, because our source material argues that Mankiw didn't go far enough. He rejected one hypothesis, but the real critique here is that the textbook model itself is the fundamental flaw.
Absolutely. The argument is that both hypotheses should have been rejected.
Both of them. Why?
Let's look at the spending hypothesis, the IS shift, under the exact same fixed price assumption of case 1.
Okay.
If we assume the price level P and the money stock M's are fixed, as the simple ISLM model requires us to do,
then the ratio, real money balances, M over P, must also be fixed. It has to be a constant.
It has to be. But what did the historical data show?
It rose slightly.
It rose, so now we have a logical contradiction.
Ah, I see it. If the spending hypothesis is true, the IS curve shifts left. That drives down income and it drives down the interest rate, which actually matches the observed interest rate fall.
So far, so good.
But because the model assumes P and M are fixed, it cannot possibly explain the historical fact that real money balances actually went up. It fails to account for one of the key observed variables.
Precisely. The spending hypothesis contradicts the real balance data, while the money hypothesis contradicts the interest rate data. The model cannot simultaneously explain the behavior of all these key variables. It's internally inconsistent when faced with reality.
So the critical takeaway here is it's profound. The conventional ISLM model, built on those twin pillars of a fixed price and exogenous money, is just fundamentally inadequate.
It can't explain the Great Depression under either the spending or the money hypothesis.
So the very first major historical test we throw at it, probably the most important economic event of the 20th century, and the model just fails completely.
It does. And if your foundational model of macroeconomics can't explain that, you have to start looking for a better model. And that failure of the static ISLM model forces us into a crucial methodological paradigm shift, a really big one. The conventional model is temporal. It's timeless. It only compares two equilibrium points, a before and an after.
But that's not how the economy works. Economic reality involves transition, it involves disequilibrium and adjustment over time.
Exactly. So we have to move from comparative statics to a dynamic system. We need a model that can show how the economy reacts and adjusts over time. And this requires a different tool, system dynamics or SD modeling.
Okay, so system dynamics. And the most important change we need to make to go from that static equilibrium to a dynamic disequilibrium is we have to get rid of that Y equals AD assumption.
Yeah, that instantaneous adjustment.
Because if the economy isn't always at equilibrium, then what is determining production from moment to moment? And that adjustment process involves a core real-world variable that the static model just completely ignores.
Inventory.
Inventory stock.
That's exactly right. We have to introduce a new stock variable, inventory stock or INV. In the real world, it's simple. If demand is higher than what you're producing, your inventory falls. If you produce more than people are buying, your inventory piles up on the shelves.
And our source material replaces that single equilibrium equation, Y equals AD, with three dynamic equations that actually model this process over time.
Right, equations 8.14 through 8.16.
Let's walk through those just to understand the extra rigor here. The first one, 8.15, shows how inventory stock changes.
It's very intuitive. The rate of change of inventory is just the difference between production, Y, and aggregate demand, AD.
Makes sense.
Then the next two equations deal with how firms actually make decisions. This is what drives the dynamics.
Because they don't produce based on what's being bought right this second. They have to plan.
Exactly. They forecast demand, ADF, and then they decide how much to produce, Y, based on that forecast, and critically, on the difference between their desired inventory level I star and what they actually have in their warehouse.
So if their inventory is getting too low, they ramp up production. If it's piling up, they cut back.
Precisely. It's a much more realistic view of how output adjusts over time, and it allows the model to operate continuously in disequilibrium, just like the real world.
But even with these new dynamics, that fixed price assumption from case 1 is just. It's completely unrealistic when you're analyzing a deep deflationary event like the Great Depression.
Totally. So the next move is to allow for flexible prices. And this brings us to case 2, a dynamic model with flexible prices, but still assuming exogenous money.
And this is an extension that Mankiw also explores in his textbook.
It is. We introduce the Fisher equation, which formalizes the difference between the nominal interest rate, I, that's the sticker price of a loan, and the real interest rate, R, which is adjusted for inflation.
The real rate equals the nominal rate minus expected future inflation. R equals I minus pi E.
And this distinction is vital because now investment becomes a function of the real interest rate, R, not just the nominal rate, II, which is how businesses actually think.
The sources mention some methodological issues with Mankiw's original version, things like unit inconsistency. But our SD model implements this rigorously. How do we model the price changes dynamically?
We introduce price adjustment dynamics, where the change in the price level, P, depends on that inventory situation.
Yeah.
If actual inventory is way above what firms want to hold, what happens?
They have a sale. Prices have to start falling. Deflation.
Right. And price elasticity determines how fast this adjustment happens.
Yeah.
If it's 0, you're back to a fixed price. If it's positive, you get flexible prices and the possibility of rapid deflation.
And what about expected inflation, pi E?
That's modeled using adaptive expectation. So as people observe prices falling, they start to expect more deflation in the future. It creates a feedback loop.
Okay, this sounds much more sophisticated, so let's rerun the tests. What happens to the spending hypothesis under case 2?
It performs significantly better. The simulations confirm that a real sector shock does capture the destabilizing effects of deflation.
How so?
Well, when prices start falling, the real interest rate, R, skyrockets.
Wait, why?
Because the nominal rate, I, is falling, but expected inflation, pi E, is becoming deeply negative. So you're subtracting a large negative number, which means the real rate goes way up.
The real burden of debt is exploding.
Exactly. And this huge rise in the ex-post real interest rate just crushes investment even further, which intensifies the downturn. This confirms Mankiw's claim that deflation made the crisis worse through the real interest rate channel. It was a key dynamic of the Depression.
That feels like a breakthrough. We can finally model that self-reinforcing death spiral of deflation, but there's still a but, isn't there? The fundamental flaw is still there.
Yes, the fundamental flaw remains the assumption of exogenous money. This model still assumes the money stock EMS is just fixed externally.
Right.
So while the model can now explain why real money balances rose because prices, P, are deflating, it explains it for the wrong reason.
Because it completely fails to account for the massive historical contraction of the money supply itself. The destruction of bank deposits was a central feature of the Depression, and this model just assumes EMS is constant.
Exactly. The spending hypothesis simulation here just assumes EMS is fixed, so it remains structurally incomplete.
Okay, and what about the money hypothesis under case 2? If we just exogenously shock EMS downward and let prices be flexible?
It's better, but still fails. It captures the money contraction and the deflation and even the rise in the real interest rate, but it still produces a rise in the nominal interest rate.
Which is still inconsistent with the historical data.
Still inconsistent. And the reason is that the model structure treats EMS as this independent input that just shifts the LM curve, rather than what it really is, a variable that is responding dynamically to what's happening in the real economy.
So this is deeply frustrating. Even after making the model dynamic and letting prices move, we still can't fully explain the Great Depression using the classic ISLM structure. The problem seems to be locked into that core assumption that the money supply is an independent variable.
And this forces us out of the ISLM box entirely. It forces us into a necessary theoretical paradigm shift, one that focuses on the true nature of modern money. And to do that, we have to go back to Irving Fisher, who, in 1933, proposed his debt-deflation theory. He was convinced that the crisis wasn't caused by a simple lack of spending, but by the financial structure itself.
Specifically, the fractional reserve banking system.
Yes. He said it led to what he called debt disease, over-indebtedness, and dollar disease, which was deflation.
And he laid out this phenomenal causal loop, his 9-point chain of consequences, that explains the whole cascading collapse. I really want to unpack this because it feels like the complete opposite of just shifting a simple curve on a graph.
It is. The chain starts when the economy is already over-indebted. Then some small shock happens, and it triggers number 1, debt liquidation.
Everybody tries to pay down their loans at once.
Desperately, which leads to distressed selling of assets. This causes number 2, a contraction of deposit currency as bank loans are paid off and the velocity of money slows down. Banks' balance sheets are shrinking.
And all of this selling and contracting leads to number 3.
A severe fall in the level of prices. That's the dollar disease. the value of the dollar swells, which means the real burden of everyone's remaining debt gets even heavier.
And then these balance sheet problems spiral downwards and infect the real economy.
Right. The price fall causes, number 4, a still greater fall in the net worth of businesses, leading to mass bankruptcies. And number 5, a fall in profits, which just cripples the ability of firms to produce anything.
Which then leads to, number 6, a reduction in output, trade, and of course, employment.
And the losses in unemployment lead to 7, pessimism and a total loss of confidence, which encourages number 8, hoarding of cash.
Liquidity preference goes through the roof. People just want to hold cash, which slows down velocity even more.
Even more. And the culmination of all these factors leads to number 9, these complicated disturbances in interest rates, specifically a fall in nominal rates.
Because there are no good lending opportunities.
And a devastating rise in real rates because of the deflation. Fisher's analysis perfectly captures all the complex historical data that the ISLM model just couldn't handle.
The most profound insight there for me is what he called the fallacy of composition.
Yes. It's brilliant.
If a single debtor tries to save themselves by selling assets and paying off a loan, that might work for them individually. But when everyone tries to do it at the same time,
the mass liquidation drives down prices for everything across the whole economy. And since prices are falling, the value of the dollar goes up, meaning the real burden of debt increases for everyone.
So the collective effort to reduce debt actually makes the whole economy poorer and the debt burden even heavier. It's a terrifying positive feedback loop.
It is. The more you try to pay, the more you owe.
Yet Fisher himself, at least initially, he still relied on the quantity theory of money, Ep.8 equals PT, to propose a solution. He called it reflation.
He did. He proposed increasing M, the money supply, through open market operations to stabilize prices. So, at first, he was still treating M as an exogenous tool, just like the Fed believed it was.
And this is where the historical irony comes in, and where his genius really shines through. He was looking for this external control, this lever to pull, but then he had this great aha moment.
He did. After he received the Chicago Plan in 1933, he realized his fundamental error. The money stock, M, was endogenous.
It's created inside the system.
It's created internally. Money creation isn't determined by some outside entity. It happens when banks make loans and create new deposits. So money is created and destroyed by the private debt cycle, not by an exogenous policy variable.
So once you see that M is actually a function of what's happening in the economy, M of T, then the quantity theory of money isn't a causal equation anymore. It's just an identity. It's just true by definition.
Exactly. MV is always identical to PT. It doesn't mean that the Fed can control M to determine P or T. It completely flips the role of the central bank on its head. They go from being a controller of the quantity of money to a manager of its price, the interest rate.
And Fisher realized that the two core premises for his own reflation policy to work, a stable velocity of money, V, and a stable money multiplier, they just don't hold up under fractional reserve banking, especially not in a crisis.
The money multiplier just breaks down. Banks become too scared to lend, and people are hoarding cash. The central bank can pump reserves into the system, but they can't force the banks to lend it out. The whole policy mechanism is crippled.
So he concluded the banking structure itself was the root cause of the problem.
He did. And this led him to abandon his own reflation theory and become a convert to the 100% money theory, realizing that only structural change could prevent these crises in the future.
This is monumental. So if money is endogenous, how does that fundamentally change our whole view of recessions through the ISLM lens? This leads us to what our sources call the endogenous money spending hypothesis, or EMSH.
Right. Under EMSH, the money stock, EMS, is now directly linked to the balance sheets of the private and public sectors. It has to be a function of income, Y, and specifically a function of investment, I, and government debt, DG.
Why? Why that specific link?
Because in a modern debt money system, that's how money enters circulation. It's created when banks grant loans, which creates private debt, or when the government issues bonds that eventually lead to new deposits, which creates public debt. Money is a byproduct of debt.
So this formalizes that positive feedback loop you mentioned earlier. Step 1, aggregate demand falls because of some real-world shock.
Right. Then step 2, that leads to a decline in the demand for new loans or even forced debt repayments as people go bust.
And then step 3, the money stock contracts because debt is being destroyed faster than new debt is being created.
And that contraction causes deflation, which increases the real debt burden and the real interest rate, which feeds back and lowers aggregate demand even more. And the cycle repeats.
This is the truly unified view. It integrates the real sector shock that Keynes was talking about with the financial mechanism that Fisher identified.
It does. And the key insight for anyone trying to model this is that the IS and LM curves must now move jointly and simultaneously. You can't separate them anymore.
A shock to the real sector immediately becomes a shock to the money supply via the debt channel, forcing both curves to shift together dynamically.
Right. The financial market's health is completely dependent on the real economy's health, and vice versa. And that interconnectedness is just impossible to model using that old, separate comparative statics approach.
Okay, so the next logical step in proving this is to actually formalize this insight into a working model.
Right.
So we move to case 4. This is the flexible price ISLM model we talked about, but now we add an equation that makes the money supply endogenous, even if it's in a simplified or mechanistic way.
Yes. This is the simplified dynamic endogenous money ISLM model. It includes all the flexible price dynamics from case 2, plus this new rule. The change in the money stock is directly proportional to the growth rate of income.
And for the simulation, this was implemented just mechanistically, right? It assumes M's increases or decreases by a fixed percentage, like 70% of the income growth rate.
It's a simple rule, yes. It's not perfect, but it captures the core intuition.
Which is that banks lend based on perceived profitability and economic activity.
Right. They're money followers. When the economy is growing, loan demand is high, everyone's optimistic, so money creation accelerates. When the economy is shrinking, loan demand vanishes, debt gets destroyed, and that accelerates the money contraction.
It's a pro-cyclical system.
Deeply. So the big question is, when this dynamic model is used to revisit the Great Depression, does it finally fit the data?
The moment of truth. Does it achieve that comprehensive fit that eluded all the previous cases?
It does. The Case 4 simulation successfully captures all the key historical behaviors that the prior models failed to match simultaneously. This is the moment the theory is really validated by the history.
Okay, let's go through those successes point by point. We need to be clear on this.
All right. First, it captures the dramatic fall in income and the sustained deflation. That's the big picture.
Check.
Second, it captures the critical decline in the nominal interest rate, which is the exact opposite of what the old LM shift predicted.
Double check. That was a huge stumbling block before.
Third, it successfully models that complex rise in the exposed real interest rate, confirming Fisher's nuanced observation about the true cost of money during a deflation.
Yeah.
Fourth, and this is crucial, it shows the massive contraction of the money stock, M's, being caused internally by the collapsing income and the debt repayment spiral, not by some outside force.
And finally, what about that confusing behavior of real money balances, M over P?
Yes. The model successfully captures the historical rise in real money balances, but now, and this is the really important distinction, it captures it for the right reason.
What's the right reason?
The rise is the result of the endogenous contraction of M's being overpowered by the even steeper deflation of P. In the old IS shift model, we just assumed M's was fixed. Here, the financial crisis itself is generating the money supply contraction, which is then dwarfed by the price collapse.
The comprehensive fit confirms the analysis.
Oh.
This is huge. This validates two necessary shifts in economic modeling. It's a devastating critique of the textbook tradition.
Absolutely. The analysis confirms, first, a necessary methodological paradigm shift.
Yeah.
You have to move from static comparative statics to dynamic disequilibrium analysis.
Yeah.
You need tools like system dynamics to model the journey, not just the endpoints.
And second,
And equally vital, a theoretical paradigm shift, moving away from that flawed assumption of exogenous money to the reality of endogenous debt money.
so if this is the case, then the traditional method of just shifting the IS curve or the LM curve separately is now obsolete, at least for analyzing major recessions in our current system.
It is. You can't talk about monetary policy shifting the LM curve independently of a financial shock that is simultaneously shifting the IS curve. They have to be shifted jointly all the time to reflect that simultaneous interplay.
It's the only way to avoid generating conclusions that are just empirically false.
Right. But while Case 4 proved the concept, we still need to go one step further. We need to make sure the links aren't just mechanistic. We need the ultimate rigor of full accounting.
You mentioned that the simplified Case 4 model, despite its success, still had limitations. That mechanistic link between the money stock and income growth, for instance.
Right. It was a useful shortcut. But to explain really complex long-term scenarios like Japan's decades of stagnation, we have to move beyond those simple correlations.
We need to incorporate the actual flows of money. This brings us to accounting system dynamics, or ASD.
Correct. ASD requires that every single transaction is tracked with double-entry bookkeeping across all sectors of the economy. We're moving from high-level equations that just represent aggregate relationships to models that ensure every dollar spent, borrowed, and saved is tracked across all the major players.
So households, producers, the government, commercial banks, and the central bank, everyone's balance sheet has to balance.
All the time. And this level of detail allows us to rigorously test the two opposing views of money creation using consistent accounting.
The flawed loanable-funds model, which insists on exogenous money, versus the robust endogenous money model, which relies on debt creation.
Let's focus on the key theoretical distinction between them, which comes down to banks and savings. In the traditional loanable-funds model, the one that still dominates standard curricula banks are just financial intermediaries.
They take in deposits from savers and lend them out to borrowers.
Exactly. So savings, S, must precede and constrain loans. L money is a scarce resource that's provided by thrifty savers.
And the logic relies on walrus law, which implies that if the goods market is in equilibrium, the loanable funds market must be too. Lending is fundamentally constrained by how much people have already saved.
But the endogenous money model just rejects this whole scarcity view. It says banks create deposits ex nihilo, out of nothing, when they make loans. They just expand their balance sheets.
So loans are not constrained by prior savings at all?
Not at all. The bank's budget constraint is radically different. The loans they provide are equal to the change in the money stock. They create the money to meet the credit demand.
This leads to a huge theoretical distinction about how the economy works, one that touches on Say's law versus Keynes.
Monumental philosophical weight, yes. In the LF model, if aggregate demand is greater than income, the logic is that the economy is running out of savings to finance that demand. So savings constrain AD back down to equal Y.
Which supports Say's law. Supply, in this case, the supply of savings creates its own demand.
Right. But in the EM model, if aggregate demand is greater than income, the demand for credit is met immediately by new money creation.
Which allows that higher level of aggregate demand to be realized now.
And then savings happen as a consequence of that. There are the leakages from the spending flow that result from the increased income.
So this supports Keynes's principle. Demand creates its own supply, and it's facilitated by the endogenous creation of debt money.
Exactly. The EM model correctly formalizes the Keynesian income determination process based on how banks actually behave in the real world.
But before we can trust the results of these incredibly complex ASD models, we have to be sure they're coherent. The source material is really emphatic about 4 rigorous validation tests that have to be passed.
Yes, this is where the true rigor lies. Test 1 is the most basic. SD model checks. This is just the software checking for unit consistency, making sure you're not adding dollars to years or flows to stocks, and verifying the model is mathematically stable.
A technical checkpoint that, you noted, Mankey's version of the flexible ISLM actually failed.
It did. Test 2 is the core of the ASD method, the ASD model check. This is really demanding. It requires ensuring that the balance sheets and the flow of funds are consistent across all sectors for every single transaction.
Every asset has a liability somewhere else. You can't create or destroy money out of thin air outside of the explicit bank lending mechanism.
You can't. If you spend $1, that dollar has to be accounted for as an asset on someone else's balance sheet.
Okay, what's test 3?
Test 3 is the debt money check. This is more of a philosophical check on the system's structure. The model has to verify the mathematical identity that the money stock is approximately equal to total debts.
Because in our system, almost all money is the counterpart to a debt.
Exactly. Our sources note specific relationships in Japan and the US. A broad money measure is proportional to private debts, while a narrow measure is proportional to government debts. If your model doesn't reproduce this basic identity, it's not accurately modeling a debt money system.
And the final test, test 4, is maybe the most profound in showing why dynamics matter, the non-equivalence check. Why is this so critical?
Because in standard simple textbook macro, it's often just assumed that the 4 main macroeconomic aggregates, GDP, aggregate demand, etc., are all equal, that GDP equals AD.
But that only holds in a perfect, steady state equilibrium, which is never.
Right. Dynamic reality is rarely at equilibrium. For example, if firms produce a bunch of cars that don't sell, GDP, what was produced, is higher than aggregate demand, what was bought.
So the non-equivalence check confirms that when you're off equilibrium, these numbers are not equal. If your model forces them to be equal, you're just modeling a fantasy economy.
A reliable dynamic model has to show that GDP is greater than aggregate demand when products are piling up as inventory, because that inventory buildup is what subsequently affects future pricing and production decisions. Passing this check ensures your model can track the painful transition phases of recessions and booms. Okay, so with these validated ASD models in hand, we can now finally do a head-to-head comparison of the opposing philosophies.
The loanable-funds model, which we'll call Case 5, versus the endogenous money model, Case 6.
And we can see how they behave when the economy faces a simple stimulus, like an increase in desired investment.
Okay, so in the loanable-funds model simulation, what happens? Logically, if firms want to invest more, demand for credit should go up, which should push up interest rates.
The model confirms that. The initial demand for credit increases, but the desired borrowing isn't fully met. And it's because lending is mechanically constrained by prior saving.
Banks can only lend what they've taken in as deposits.
Right. Lending equals the minimum of either desired borrowing or available saving. And since there's no mechanism for banks to create money, the money stock, EMS, doesn't increase significantly.
And what's the result for the economy?
Production stagnates pretty quickly because the necessary funds for that new investment just weren't supplied. And the nominal interest rate converges to a fixed, higher level because of the scarcity of savings.
Wait a minute. The loanable-funds model is still taught as the standard way to understand interest rates and scarcity. How can something so widely taught be fatally flawed?
Because it fails to recognize the functional reality of modern banking. The LF model cannot generate the money needed to meet growing aggregate demand. It assumes growth is constrained by prior thrift.
And that constraint causes growth to just stifle itself prematurely.
It does. The LF model is structurally flawed as a tool for analyzing our current debt money system, where credit is what fuels growth. It's fundamentally suffering from the same core weakness as the original ISLM, the assumption that money is exogenous.
Okay, so in contrast, what happens in the endogenous money model simulation when investment demand increases?
In the EM model, when investment demand goes up, the desired borrowing is met by deposit creation. The banks just expand their balance sheets to accommodate profitable loan applications.
So the money stock increases.
It does. Production GDP continues to grow. And perhaps counterintuitively for some, nominal interest rates tend to decrease or at least remain stable.
Why is that?
Because the expansion of the money supply by the banks simultaneously increases the supply of loanable funds. This dynamic behavior, the true joint shift of the IS and LM curves, is accurately captured only by the EM model.
This means the entire Keynesian exogenous money theory, the view that savings precede and constrain loans, can no longer be applied in a legitimate macroeconomic model of our current system.
It really can't.
If money is just created when a loan is made, that fundamentally negates the entire concept of the scarcity of savings that underpins decades of mainstream economic thinking.
It absolutely negates that core classical premise.
Yeah.
The consensus from this analysis is that the money creation process validates Keynes' principle of effective demand through the mechanism of debt.
But you made an important distinction earlier. The LF model isn't useless, it's just wrongly applied to our current system.
That's the key qualification, the public money distinction. The loanable funds model is logically coherent, and it would be suitable for a hypothetical public money system.
What would that look like?
If a nation adopted Fisher's 100% money proposal, where the money supply is truly exogenously controlled by a public monetary authority, and commercial banks are just pure intermediaries who can't create credit,
then the loanable funds model would suddenly be the right framework.
it would be the appropriate framework. In that hypothetical system, targeted public money injections would lead to predictable growth without creating all the private or government debt. It's a model for a system we don't currently have.
Let's turn now to Japan. This case study provides the ultimate empirical test that just exposes the limitations of all these previous models.
Absolutely. The economic outcome in Japan's lost 30 years after the 1990 bubble burst was a huge, long-running puzzle for standard economics.
The scale of the fiscal policy puzzle is just staggering.
It is. The Japanese government accumulated an enormous amount of debt. They increased it by 595 trillion yen over 3 decades. That averages out to 20 trillion yen in deficit spending every single year, trying to stimulate the economy and fight off deflation.
And yet, the result was economically minimal. GDP only rose by a total of 60 trillion yen over that same 30-year period.
An average increase of only 2 trillion yen per year.
When you look at that effort versus that outcome, the standard textbook predictions just become absurd.
They do. If you applied the standard Keynesian ISLM analysis to that spending, using typical parameters, the fiscal multiplier is calculated at 2.427.
Which would imply that a yearly spend of 20 trillion yen should have resulted in a GDP increase of almost 48.5 trillion yen every single year.
Right, and the actual outcome was orders of magnitude smaller. Policymakers were operating under the illusion of a textbook fiscal multiplier that just didn't exist to the real world of Japan's debt-ridden, zero-rate environment.
And the failure of the standard models here is really twofold, starting with the notorious crowding out myth.
Yes. Mainstream economics, because it relies on that flawed LF model, predicted that such high government debt would inevitably cause crowding out.
The idea that government borrowing would suck up all the available savings, drive up interest rates, and crowd out private investment.
Exactly. And the LF simulation, case 5, confirms this prediction. It shows rising nominal interest rates.
But the reality in Japan was the complete opposite. Nominal interest rates continued their relentless decline towards zero, and they've stayed there for decades.
And the EM model, case 6, correctly simulates this decline in nominal interest rates.
Why? What's the mechanism?
Because when government debt is accumulated and financed by commercial banks, it endogenously increases the money stock. New deposits are created when the government spends that borrowed money. This accumulation of new money actually pushes rates down, even while public debt is soaring.
So the crowding out myth is demonstrated to be a failure of the loanable funds paradigm to understand how debt money is actually created.
Completely. And most critically, the EM model successfully captures the ultimate economic path that Japan took, what the sources call point J.
What exactly does point J represent?
Point J is that stagnation point we actually observe in the data. Low income combined with a persistently low interest rate, a state that was reached despite all that aggressive fiscal spending.
The standard ISLM would have predicted something completely different. It would have predicted that massive fiscal spending would lead to high income and high interest rates if you believed in crowding out, or at least high income and low rates if you just thought the IS shift was dominant.
Right. And the EM model explains why that expected outcome never happened. It demonstrates the complex, dynamic joint shift of both the IS and LM curves under endogenous money.
So what was happening?
The real sector, the IS curve, was constantly being dragged left by private debt destruction and deflationary pressure from the bubble bursting. At the same time, government spending, the fiscal policy, was creating new money and trying to shift the LM curves right.
So the two forces were counteracting and complicating each other.
Exactly. And the result was stagnation at point J, not the predicted growth. The old models were just incapable of simulating this necessary complex interplay.
So this case study serves as the final long-term validation for the ASD model, reinforcing everything we learned from the Great Depression analysis.
It does. And furthermore, the EM model successfully reproduces the core macroeconomic relationships we actually see in the Japanese data. That broad money is approximated by total debts, another measure is linked to private debts, and a narrow measure is linked to government debts. It demonstrates the model's structural validity for the modern debt money system. #takeout Shrodro.
Wow. This has been a profound journey through the mathematical foundations of macroeconomics, and the conclusion seems inescapable. The foundational Keynesian models based on exogenous money, from the simple static ISLM all the way to the rigorous loanable funds ASD model, are all structurally and empirically incorrect for analyzing major economic events in our current system.
They're based on flawed assumptions about money creation and its interaction with the real economy. The only valid framework that's capable of consistently explaining both the severe deflationary spiral of the Great Depression and the complex long-term stagnation of Japan is the endogenous money ASD model, case 6.
Which demands a total rewriting of undergraduate macro.
It really does. Replacing the concepts of savings constraints and exogenous money with the reality of debt-fueled credit creation.
And this systematic error has deep historical roots. Our sources detail what has been called the lost century of economics.
Right. For decades before the 1940s, the true loans create deposits view, the idea that banks create new money when they lend, was actually the consensus among major economists. It was understood.
But that view was systematically challenged and eventually overturned.
It was. Paul Samuelson, in his hugely influential 1948 textbook, broke with that tradition, and he popularized the financial intermediation theory. The deposits create loans, or fractional reserve mythology.
A simplification that was eventually endorsed by the Federal Reserve itself.
Yes. And it confused generations of economists and policymakers by hiding the inherent complexity of bank credit creation and just assuming money was always a fixed quantity that the authorities controlled.
And the result was the popularization of models, like ISLM, that deliberately misrepresented reality, pushing the true concept of endogenous debt money into the background, where it was treated as this sort of dangerous or false explanation.
It's an almost unimaginable failure of institutional memory in an academic field.
So if economists are going to move past this century-old confusion, overcome this structural blind spot, and properly address complex modern problems like persistent inflation and rising income inequality,
which our sources suggest are also fundamentally connected to this flawed systemic structure,
they have to fully abandon the exogenous money assumption and embrace the paradigm shift to endogenous money analysis.
The math now proves what the empirical data always hinted at. The banking system itself is the driving force of instability and also of opportunity.
A profound challenge to the very foundations of an entire field. This raises an important question. What are you going to look into next? Thank you for joining us for this deep dive.